Well, welcome, and thank you for joining us for our webinar on an introduction to private equity for physician practices. Our disclaimer, this is not an offer to sell or offer securities or services. If there's an offer for securities, it'll be done with the prospectus, and it's done through Cascade Partners BD LLC. So again, welcome. My name is Raj Katari. I'm a founding member of and managing director of Cascade Partners. I've spent my career helping organizations build value, in some cases recapture value, and ultimately realize the value in the organization that they've created. I lead our healthcare practice here at Cascade Partners, and I really draw on my experience leading two different healthcare-focused private equity funds. I've been a board member of both payers and providers, and I've been a transaction advisor across a variety of industries, including physician practices and specialties such as emergency medicine, GI, neurology, pain, ophthalmology, and a variety of other specialties. And I use that experience hopefully to share some insights today with you all. So let's face it, the paradigm has shifted. The business of healthcare has evolved. And you're going to need to start thinking about the future differently if we're going to be successful in what's the new world that we're operating in within healthcare. Part of this is because I hear every day from physicians, I'm working harder and making money each year. And that's being driven by, reimbursements are continue to decline, expenses, labor, technology, tools, they're all going up. And at the same time, patients are demanding more from their providers, whether it's online appointments, telehealth, or access to you and your staff. And in most cases, it has very, very little reimbursement. And like many other businesses across almost any sector, it's just getting much harder to do business as we progress through into 2024. And that's having an impact. Right? It's having an impact on physicians. Today, scale matters more than ever. Physician practices as a whole are fixed cost businesses. What I mean by that is, as your revenue continues to grow, the costs associated with generating that revenue traditionally don't go up linearly. And so if I'm able to spread a greater base of revenue over that base of fixed costs, that's one of the ways fixed cost businesses can become more profitable and overcome some of these challenges. And this is what many have shifted to. So, this is the first time in 2022, this is AMA data, this is the first time ever that more than 50% of the physicians practicing don't own the practices that they're part of. And as you can see in the graph, right, increasingly, they're becoming much larger practices with 50 and greater physicians, and the number of small practices, 10 and less, is declining, and it's declining at an accelerating pace. So the reality is the scale is what's an element of driving that, because folks have realized that's one of the ways they can build an organization that can sustain these pressures of declining revenue and increasing costs. At the same time, right, new physicians' mindset has changed. Younger docs are looking at this differently. They have more dynamics influencing the path that they want to take, whether it's debt, work-life balance, or just their entrepreneurial spirit. They're looking for greater certainty, greater consistency, and they still have greater expectations. On average, a new physician coming out of medical school is leaving with over $200,000 in educational debt. That makes it much harder for them to buy into a practice, buy into an ancillary service with their practice. They're just looking for greater stability. That doesn't stop them from wanting equity and being a partner, but the value of that partnership and that value of that equity in your practice has changed dramatically over the last 10 to 20 years. And private equity is part of the reason that changed. So the ability to do that, as it's been done in the past, isn't the same. And the reality is, while we're spending our day today talking mostly about private equity, you have options, right? You need to understand your goals, your risk tolerance, and the needs that your group has in order to figure out what that right path is. But today, let's spend our day just talking about what's going on in private equity. That's our focus. And we're going to try to provide some insight on what that private equity partnership can look like. So let's start out about talking about what is private equity. Reality is private equity is basically a group or company that gets money from outside investors in order to invest in private companies. They use those dollars to buy and then grow those businesses over the next 4 to 7 years in order so they can sell the business again or the practice and generate a return from for their investors that they got their money from. They do this by building the organization. They're building the infrastructure to support growth. And they're doing that growth either through organic, building new clinics, opening new locations, and they also do it through acquisitions. So you might say, okay, well, why is private equity interested in the physician world? Well, the reality is it's a large market. It's over $300 billion in the physician provider market alone. And the other dynamic is that world has changed. What used to be a cost plus is obviously now a fee for service world. And it's very fragmented and very inefficient. And those are two things that private equity benefits from, because they're able to bring processes, experience, and skill sets that they've honed in the businesses, commercial businesses, and bring those to bear on the operations of physician practices. They also like them because healthcare is recession resistant. Even with the dynamics of COVID and many clinics being shut down, most practices did very, very well in 2020. And so as a whole, private equity likes that recession resistance that exists in physician practices. And lastly, there's a lot of opportunities to generate revenue from adding specialties, adding ancillary services, and even driving the consumerism of healthcare has created an opportunity to generate multiple streams of revenue. And those exist within the physician practice world in a way that doesn't exist in a lot of other industries. So this is happening because there's not a lot of sophisticated business practices in most physician practices. And that's one of the areas that their private equity tends to be experts in, because they've done this across hundreds of companies. The other side of it is running a physician practice today is getting more and more complex, and trying to stay compliant with a growing number of federal and state regulations, as well as compliant with the rules and obligations that payers have. You can't do this anymore with a staff person just helping schedule, do billing at night. You need professional business leadership driving very sophisticated activities within your practice, from revenue cycle management to marketing, driving patients, and managing that flow. You know, being a great doc is a full-time job. Being a great CEO is a full-time job. Guess what? You can't do both. And there's been a lot of success. Hundreds of practices have explored and executed transactions to build, scale, and grow across a variety of specialties. And there's been a lot of success. And in some cases, there's been second and third bites of the apple, as organizations like the ones right above have been able to grow, build, scale, sell more than once. And physician partners have been able to ride that success curve along the way. That success is begetting more opportunities. So that's wonderful for the private equity groups, but you're like, well, why would I partner with a private equity partner? Well, they're value-added partners. They're experienced in building businesses. That's what their whole career or their whole business model is all about. And they haven't done it once, but they've done it dozens or hundreds of times across a variety of businesses, working to help them put the infrastructure, build the leadership team, and go out and execute the growth strategy, again, whether it's organic and acquisitions, to drive that success. And they have the capital to put behind their talk, because those things take investments. But as we'll talk about a little bit later, you got to pick a good partner. So you've got to make sure you've got great alignment with your partner. And private equity by its model creates economic alignment, but you've got to make sure there's more than just economic, cultural, philosophical, operational alignment as you think about a partner. We'll talk a little bit more about that later. They do create economic alignment because what you own and the private equity own is the same stock in the same organization. And if they're making money, you're making money. And they create that alignment to keep everybody involved in the organization. Many times I hear, hey, this is great for the senior docs. They're going to do a private equity deal. They're going to get a huge payday and they're eventually going to go retire. I'm a young doc. I still got 20 years left in me. Why would I ever do this? And the reality is these opportunities can be great, not just for the docs in the later part of their career, but mid-career and even early career physicians. For if it's done right, there's the most economic opportunity for younger docs because they have the ability to participate in that growth multiple times and take chips off the table along the way. The challenge is this is a shift. It's a shift from how most physicians have been trained or have thought of, hey, right, cash flow is the most important thing. It's a shifting from cash flow to thinking about how I create equity value. And younger physicians have the opportunity to create multiple opportunities to build equity value over time as the organizations go through private equity partners and build scale. Starting out as a single practice, growing to a multiple or maybe a super regional, and then ultimately maybe going to a national provider. Those steps along the way create fantastic revenue and growth opportunities for physicians to be successful. And for mid-careers, it's often about lowering the risk profile. It allows them to take chips off the table. That growth and that investment doesn't have to come out of their pocket. They've got a partner, and allows them to go back and focus on what they're excited about, which is focusing on their clinical activity rather than their administrative or operational duties that sometimes many practices have to deal with. So it creates opportunities for each type of physician, regardless of where they are on their career path. Now look I'm smart enough to know you all talk and hear all the different aspects of private equity, the good, the bad, and the ugly. I'm convinced that someone runs around at residency programs around the country and saying how evil private equity is. The reality is there are bad private practices, there are bad physician partners, and there are bad hospital partners. And yes, there are bad private equity partners, but there are also good private equity partners, just like there are good private practices, good physician partners, and hospitals. You have to learn about your partner and make sure it's a good fit and alignment with you and your organization. Let's talk about that. You've got to do your homework. You've got to look deeper than the money and understand what is my partner all about. They're going to do a ton of due diligence on you as they learn about your organization and your practice and your culture. And you've got to do the same in learning about them, right? You have to take the time to understand what motivates and drives the partner and what have they been successful doing in the past. Take time together, both formally and informally. Call references. Talk to other physicians that are in their practices and even those that are no longer part of their practice. So you get the real story of what kind of partner they're like. And recognize, in order to be able to do this, you have to be able to compare and contrast. I describe this often as speed dating before you getting married, as you go through the process of evaluating partners, but you got to have options and take the time to get to know so you can figure out who matches up, creates that alignment in good times and in bad times. And there's where it can help you be successful in the long run as you look at that partnership opportunity. So as we transition, I get a lot of questions about, well, what's my life going to be like the day after? And there's not going to be a lot of changes. right? When they first start, they're not going in to change everything right up front. They're going to take their time. Over time, the back office process will change because they're trying to build scale, build infrastructure that'll support growth. So your systems are going to change and your team is going to change because they're going to work to bring in stronger business, more professionalized business leadership that has experience growing 2, 3, 4x in size over time. And most practices don't have that talent in-house today. They're going to focus on efficiency as well. Oftentimes I hear physicians ask, well, are they just going to come in and cut costs in order to make profitability? No, they're going to look at efficiencies, but they're not looking just to cut costs. What they're not going to do, though, is they're not going to tell you how to practice medicine. Gotta go back one. Right? They're not in the business of practicing medicine. That's what the physician is there. So they're not going to tell you how to practice medicine. They're not going to tell you what drugs you have to use or what equipment. They might educate you about the cost dynamics and the impact, but the clinical decision is going to be up to the physician, right? The private equity isn't going to be running the business day to day. They're going to hire a management team. That's who's going to be operating day to day. The private equity team is going to help at the strategic level, at the board level, setting the direction. And the other element is they're not taking all the cash and distributing it to shareholders. They're going to use that cash and reinvest it in the business, as we're going to talk about it in a second. So as we move from kind of talking about the private equity as a whole and what they're looking for, you can't have that conversation without diving a little bit into the deal. And we're not going to talk about transactions themselves, but I want to talk about the structure and the impact, the details of the deal and the opportunity it can have for you. So the first area we got to focus on is what's the timeline of a private equity investment? As I said, they're getting capital from outside sources and they have to return that capital with a return at some point. Most private equity firms try to target a 4 to 7 year cycle from when they're investing, growing, and then beginning to exit those investments. So what you see on the slide above is that's the typical cycle. What happens for you and what your experience depends on when you're joining the private equities companies and that investment and where they are in their journey. So if they just start, if you're the entry point, if they start building from you, often what is referred to as a platform, right? They're at the foundation period. Platforms tend to be larger practices with a lot more infrastructure. So the basic bones are there from which to grow. And in those cases, they're going to start by beginning to professionalize that management team, add resources to drive growth, but they're going to be building off of the tools and the components that you have today. And they tend to be more flexible because the path, the goals, and the end process haven't all been defined yet. But if you're a smaller practice or you're joining in that middle period, that high growth phase, right? The intensity, the flexibility is lower at those stages because they have a rhythm, they have a cadence, they have a game plan that they're using to execute their growth platform. So whether you're being acquired or merging with an established, the flexibility is going to be less because there's more behind what you're partnering with. The positive side is there's greater scale and you're benefiting from that scale, whether that's borrowing power or sophistication of systems. When you're that first one, while you're larger and you've got more influence, your partner is learning about you and your specialty because they're early in that investment. So there are trade-offs depending on where you are in that cycle. And one of the things we talked about earlier is the change that happens when you have a private equity partner, right? And this is one of the biggest changes around profits. Today, the profits of your practice go to the shareholder, whether they're doing it through distributions or other payments. At the end of the day, every year, most practices don't generate a profit. They've got a zero profit because they've distributed a partner. After private equity comes into place, they're no longer taking that cash to shareholders, right? Because they've already, we've trued that up. We'll talk about that in a minute. They're taking that money and they're reinvesting in the practice. They're either investing in the practice to build the clinical operations, to add management, systems, staff. They're funding growth. They're doing acquisitions. They're opening up new clinics and new locations. And they're also beginning to pay down debt. When they do the transaction, debt is often a component that's owned at the corporate level, not at the individual level. And that debt is getting paid down. And as we talk about next, that debt actually works to your advantage, right? Because what happens is you're an owner in the organization that has both equity, you're an equity owner in the organization that has debt as well. And it's kind of like a home mortgage. As that debt gets paid down over time, your equity value increases if nothing else changes. And so instead of using all that cash to do distributions, they're using that cash to invest in the practice, grow the practice, and pay down the debt, which is increasing the equity value that you own because now you're a shareholder in this bigger entity. And the concept of debt can be a complicated one for folks to grasp, especially when they've run their business on a debt-free basis. So let's talk about a couple of the other important things to think about in a deal, right? As I just said, you're going to continue to be an owner, a shareholder in the new entity, typically, which is a medical service organization or an MSO. And it's the same ownership as your investment partner. And so that's one of the elements that creates alignment. Because again, you're going to have the same ownership at the same ownership level as your private equity partner. So if you're making money in your equity, they're making money and vice versa, as long as your deal is structured properly. But recognize you're going to have a non-compete in this area. And that can often be a challenging element to understand and appreciate. But the private equity partner doesn't want to give you a whole bunch of money and then have you walk away. Company valuation ends up being a very important part of this. We'll talk a little bit about how those play in. Decision making. Who's going to make the decisions, right? The PE is going to drive the operational, the organizational decisions, and they're going to do that through a board of directors. But the clinical decisions are going to remain with physicians. But you might be going from a group with 5 physician partners and ultimately becoming an organization that's 50 or 100 physician partners. And in those cases, individual physicians aren't going to get to make all of the decisions, just like in any large organization. But physicians will be making decisions that drive physician behavior. So whether that's a clinical advisory board or a medical director, there'll be a group that can help drive those decisions. And you'll become an employee of the practice, right? Today, you've been a shareholder. Going forward, you're going to be an employee of the practice with a contract, getting market compensation at the same time that you're a shareholder in the MSO. And one of the big elements for them, and one of the key risks they're worried about, is making sure that you continue to produce and generate the revenue that you've been doing, because the cash flow and the value that they're defining is based on your ability to see patients. And guess what? There's another non-compete that exists at this level. All right, let's talk about everybody's favorite topic, valuation. No doubt, you're the best practice ever. You have the most respected physicians, and you're worth $1 bazillion. Well, the reality is that's not always the case, right? So you've got to take the time and make sure that you're backing that up. And the first place this starts is around EBITDA. What the heck is EBITDA? EBITDA is earnings before interest, tax, depreciation, and amortization. It's a measure of cash flow and sometimes profitability, but not precisely. It's designed to be measured on a consistent basis, regardless of tax or ownership dynamics. Like, hey, do I have debt or not have debt? Which don't really affect the value of the business. The other element is that practices typically run on a cash basis, and the rest of the world runs on an accrual basis. There is a big difference here, And it's an important area to make sure you have your arms around as you're thinking about your results, because it is the consistent way to make sure there's no fluctuations, and it provides the most consistent and reliable way of measuring across different businesses. So at the end, as I said before, most practices don't generate any real profit because they bonus out the excess to shareholders. So how do we actually create EBITDA? Because that's where valuations start from. Well, we look at it differently. Physician shareholders are compensated in two ways. They get paid a market compensation as a provider, and they also get distributions or profits as a shareholder. Now, sometimes those are blended into one check, and it's, hey, I take everything off at the end of the day. But at its core, there's really those two components, because if you had an employed doc, you'd have to pay them market compensation. And since you're a doc providing, you have to get paid market compensation. But you're also a shareholder, and so you're getting your distributions as a shareholder. So when you make these adjustments and you go look through and get physicians to a market compensation, the bulk of the profit, or it becomes the majority of EBITDA, tends to be those profits, as well as the success of your ancillary services. And this becomes the anchoring point from which valuations are based in most physician practices. Now, once we've got that base, there are lots of things that influence that valuation range. And those are the things that will drive, well, are you above the mean, below the mean, or right at the mean? What's the clinical reputation of the group? How much infrastructure do you have? Can it support growth? Do you have real leadership? How sticky are your referral sources? All of those are the qualitative elements that go into evaluating a practice and determining what the multiple is, but really, ultimately, how are they valuing that cash flow stream? How strong is it? How robust is it? Is it a premium or is it not? And it's more than just your great practice. You have to back that up with data and information that supports that you are the best practice. Because I've never met a practice that's gone to me and said, we're eh. The reality is you've got to back it up with the data and show this is why we're a strong practice, a superior practice, in order to drive that valuation range based on the EBITDA that the practice is actually performing. So if you're not making any money, it's very hard to drive tremendous value, as opposed to if you're generating a lot of cash flow, it becomes much easier. Because at the end of the day, remember, the private equity investor is trying to generate a return for their investors. And they do that by driving growth. And the same thing happens when they exit, is they're looking at what's the value creation, reputation, EBITDA, what's those ranges. All of those come together to be able to provide that valuation and the things that influence valuation. So hopefully that gives at least a cheat to begin to think about how you can drive that within your practice. So as we've talked about all this and the impact of private equity, please recognize that you have options. You have to determine what's best for you and your team. And this will give you a sense of what some of those options are, but focus on what you want and not how to get there. Oftentimes practices are talking about, I've got to do this or that, because they're trying to accomplish an end goal. Focus on your end goal, right? Determine your high level of objectives and what you want to get out of it, and not how to get it done. You can turn to your advisors and partners to figure out how to get it done once you know what those objectives are. Be open-minded. The world has a large number of opportunities, more than you probably realize, in how to accomplish those goals. This is a big and complicated move, and it's difficult to undo. So put the time and thought process to figure out, what risk tolerance do I have? What do I need? What are the benefits I'm looking for? And what are the drawbacks I can live with? It's amazing how just misalignment of expectations takes many folks off track, because they expected one thing, they didn't ask the question, they got to the end and they were very surprised. So take those time to ask those questions. And as you're going through this, remember you have partners. You have partners today in your practice. It can't be all about what you need. It's got to be, how do we craft a solution that meets the different objective that our partners have, and recognizing that I might not get everything I want, but the other partner might not be getting everything they want. It's a balance. It's a trade-off in order to get to a good solution. And many folks come to us and say, look, we got all these problems. We can't do any of this. We can't look at how we grow. How can we execute any of these alternatives? And the reality is every practice has challenges. In the end, you're going to have to find a new way of operating. And these 4 here on the screen are just a couple of examples of how you can look at what your future might look like. Do we stay the way we are? Do we try to grow on our own? Do we create a super group, or do I find a private equity partner and help us achieve the results for what we're trying to get done? So as you're thinking about preparing to grow and go through this change, start by getting educated. Don't rely on hearsay and what you heard in the golf course or what have you. Get professional advice and guidance and ask lots of questions. Take your time, right? Understand all of the elements before you dig into this. It's going to take time. Understand, as we talked about earlier, young docs, old docs, there are a lot of different controls and concerns and goals, and that's okay. Lay them out on the table, work to find solutions, and a partner that understands those challenges so you can create a solution that works for your team. You know, doing things the right way over a long time is what really matters. It's not about what could be done. Everybody's got plans and visions of grandeurs. What have you done, and what can you show that you've done well? As I said earlier, every practice thinks they're the best, right? Prove it. Show the data. And it's amazing how much a little humility goes a long way in building that partnership. Get your house in order, clean up your books, get your billing and collections in the best place, your corporate records and your financial. Sometimes you got to get outside help to look at those and say, hey, are they really up to snuff? And it's not up to snuff for you. It's up to snuff for how the rest of the world looks at this. This is a complex process. Know that it's going to take time and be ready for that. So in closing, let me leave you with a couple of thoughts, right? This consolidation that's happening within the private equity world is, within the physician practice world is going to continue. Competition is going to increase whether you're part of the private equity groups or you're not. Scale is going to be really important to you, and you have to figure out how you are going to grow. There's no right way or wrong way. You got to find what answers for you. And there's nothing wrong with staying independent, but you're going to have to figure out how you're going to do that successfully. Often we get asked, hey, is this over? Is all the hype of private equity and I'm getting on the train late? Train hasn't left the station. There's lots of opportunity. There's still a tremendous amount of fragmentation in the market. There are practices that have been very successful with private equity partners, and there have been some that are very successful independently. So you have to figure out what really works for you. But no matter what you do, you're going to have real management expertise and forward thinking to be a successful practice as you look out 5 and 10 years into the future. At the end of the day, you have choices, but taking no action, what's the saying, right? The definition of insanity is doing the same thing and expecting a different result. So if you're not happy with what your organization is doing today, you got to look at how you're going to change. Well, I hope you enjoyed the discussion. I'm happy to answer any questions that folks may have posted and in the session. Let's see. One of the questions that was asked is, aren't PE firms only interested in making money? They're going to make me do certain procedures, use specific drugs or certain equipment. So yes, they're focused on figuring out how to make money, but so are you as a practice. But what changes is they're not going to tell you how to practice medicine. It's not the goal of how private equity works. They've recognized years ago, they tell docs what to do. Docs are just going to walk away. They're going to educate, they're going to provide information, but they're going to let docs do what they're going to do. Where they are going to focus on is, hey, how do we be more efficient? How do we schedule better How do we optimize what we're doing operationally? How do we improve collections, billing, et cetera? Those are all things that private equity firms are going to look at as they begin taking on a physician practice and looking to grow it. Let's see. We talked a lot about PE. What about selling to hospitals? So hospitals continue to be active acquirer of practices. And I've sat on the board of hospitals, and you understand the thought process. But remember, a hospital is focused on making the hospital successful. They're not as focused on making your GI practice the best GI practice in the world. They're focusing on how does that GI practice drive the success of my hospital. And that can create great opportunity for you if you have the right relationship with the hospital and that partnership. But at the end of the day, what I always describe is hospital is focusing on what's in the best interest of the hospital. As you're building your practice, what is best for your neurology or ophthalmology practice is what you're focused on. And that's where you're driven because you're focused. Private equity has the same element. They don't create very many multi-specialty groups. They typically are focused on single specialty groups and doing all the things they can within that specific specialty to make it successful, whether it's new techniques, billing practices, expertise, what have you. That's their singular focus. So for the right needs and goals and risk profile, a hospital can be a great solution. But their objectives don't always line up with the specific objectives individual physicians have within a specialty and their growth and desire to grow. One last question is, do we have to do a private equity deal? Why can't we just stay independent? As I said a second ago, clearly staying independent is an option for practices. And there are very successful practices that have stayed independent. The dynamic is you have to think about what's your growth strategy. Staying independent and staying stagnant are two different things. If you're thinking like, hey, I can just keep doing what I've been doing for the last 15 years, I think that strategy is going to be challenged. The concepts of practices having egalitarian, where everybody's equal partners, becomes more and more challenging as your competitors get more nimble. They react and focus on the business of healthcare on a more timely and regular basis. And as all the pressures we talked about in terms of costs and revenue impact, the ability to stay independent and stay stagnant, I think is challenged. It's all about how are we thinking about growth and building scale so we can compete successfully in the private equity world. Again, my name is Raj Katari with Cascade Partners. I hope you enjoyed this webinar. If you have additional questions or want to discuss any aspect of what we've covered today, please feel free to reach out to me, either my phone number here or my email. As I said in the beginning, we're happy to make the webinar available as well as the slide deck if you just send me an email or Linda T at cascade-partners.com. Thank you very much for joining us today, and I hope you enjoyed the session.